Tax the rich and inequality disappears, right? Wrong. Sweden once taxed its top earners at 87%, yet billionaires multiplied. France taxed wealth so hard that 42,000 millionaires fled the country. The Netherlands, their richest, quietly doubled fortunes since 2008. So if the taxes are sky high, why does inequality keep climbing? That's today's scandal. If high taxes fix inequality, why are the rich still winning? A politician steps up to the podium. With a proud smile, they announce, "We're raising taxes on the rich." The crowd roars. Middle-class families clap, believing life will finally get fairer. But cut to the next scene. Billionaires clinking champagne glasses on their yachts, while ordinary households grumble at higher grocery bills. And here's the twist. This isn't fiction. It's happening in some of the world's most equal countries. France tried harder. In 1989, they introduced a solidarity wealth tax that targeted the super rich. The result? Between 2000 and 2016, 42,000 millionaires left France. Even actor Gérard Depardieu famously fled, calling the system suffocating. And here's the kicker. Inequality still grew because the rich moved assets overseas while the middle class got squeezed harder. Meanwhile, Dutch loopholes let corporations slip past taxes. So here's the uncomfortable truth. Even in countries with the heaviest tax burdens, inequality hasn't disappeared. It's grown. Because taxing the rich on paper doesn't stop them from moving wealth around. Instead, it often lands harder on those who can't escape, the middle class. But if the taxes don't close the gap, what actually keeps the wealthy getting wealthier? To answer that, we need to peel back the history of money itself, what it really is, and why trust matters more than tax rates. Europe's high-tax paradise, or is it? Imagine moving to Sweden in the 1970s. On paper, it looked like paradise. Universal healthcare, world-class education, generous welfare. But here's the catch. If you were a top earner, the government could take over 80% of your last dollar in taxes. In fact, by 1979, the top marginal rate reached 87%. That meant for every extra $100 you earned, you kept just $13. Surely that should have crushed inequality, right? Well, not exactly. Sweden today still has one of the world's highest overall tax burdens, about 44% of GDP. Yet wealth inequality has crept back in. And then there's the Netherlands. With progressive income taxes and wealth-based levies, it looks like the ultimate fair play system. But in reality, the Dutch became famous for another role: a corporate tax haven. Companies like Google, Nike, and Amazon routed billions through Dutch subsidiaries, avoiding taxes elsewhere. So while Dutch households pay 21% VAT on groceries and goods, global giants quietly slip through loopholes. Meanwhile, the number of Dutch billionaires has nearly doubled since 2008. So here's the paradox. The countries with the toughest tax regimes still see wealth gaps rising. Politicians raise tax rates, the public cheers, yet the rich adapt and even thrive, while the middle class shoulders the everyday burden. And that raises a sharper question. If high taxes don't stop inequality, what hidden doors are the wealthy walking through? The rich always find a back door. Here's the thing about wealth. It's not just about your salary. Workers live on wages. The wealthy live on capital, stocks, companies, land, and royalties. And capital always finds ways to move. France offers a famous case. Actor Gérard Depardieu made headlines in 2012 when he moved to Belgium, then briefly flirted with Russian citizenship. Why? To dodge France's 75% super tax on high earners. He wasn't alone. Thousands of wealthy French quietly packed their money, and sometimes themselves, offshore. The wealth tax, ISF, didn't shrink inequality. It just shrank France's millionaire population. Meanwhile, the Netherlands wears two faces. For citizens, there's no escape from income tax bans up to 49.5%. But for multinationals, the country practically rolled out a red carpet. The so-called Dutch sandwich tax structure let giants like Google route profits through Dutch entities to Bermuda, slashing global tax bills. Nike shifted billions through Dutch entities, cutting tax bills drastically. What does this mean? High taxes are like closing the front door on inequality, while leaving the back door wide open. The rich don't just evade taxes illegally, they avoid them legally, by moving capital, assets, or even themselves. But here's where the story twists. Is this simply about loopholes and escape routes, or is something deeper at play? Something about how money itself is created, multiplied, and preserved. The middle class pays, the rich invest. Across Europe, VAT hits daily life hard, 25% in Sweden, 21% in the Netherlands, making every purchase costlier for ordinary families. Meanwhile, billionaires don't pay their fortunes at the cash register. Their wealth isn't in salaries, It's in assets that grow quietly, shares of Spotify, real estate, or private companies. While the average worker pays payroll taxes directly out of each paycheck, the wealthy see most of their money grow through capital gains. And those are often taxed far more lightly, if at all, depending on where they live. Take Amazon as an example. During the dot-com bust in 2000, its stock collapsed by 90%, dropping from $100 to just $6. Most ordinary investors fled, panicking at the loss. But Jeff Bezos kept reinvesting, pouring resources into warehouses, logistics, and eventually cloud computing. That persistence turned Amazon into a juggernaut. From those lows, the stock rebounded by nearly 8,000% over 2 decades. The lesson: the middle class sells to survive, while the rich invest to expand. Globally, the numbers are staggering. In 2021, billionaire wealth ballooned by $2.5 trillion in a single year, fueled by rising stock markets, tech valuations, and property booms. Ordinary households, meanwhile, saw stagnant wages and rising living costs. This isn't to say taxes don't matter. They do, but not in the way politicians promise. Workers feel the squeeze immediately through payroll deductions and consumption taxes. But the wealthy, by keeping assets compounding, often see their effective tax rates shrink. For example, Warren Buffett once revealed that his secretary paid a higher tax rate than he did, thanks to this income versus capital divide. So the cycle repeats. The middle class pays steadily, while the wealthy reinvest and multiply. But here's the big question. If taxes don't balance the scales, and the middle class is always footing the bill, what actually drives prosperity? And who decides how wealth really grows? Ayau's principle. Prosperity comes from production, not redistribution. Let's pause and flip the script. Manuel Ayau, the Guatemalan economist nicknamed Muso, spent decades warning about a dangerous illusion. Governments think they can tax, shuffle, and redistribute their way into prosperity. But as he put it, redistribution only fights symptoms. It never creates wealth. Real prosperity comes when people are free to build, produce, and exchange. Take Sweden. Everyone talks about their generous welfare state, but few remember the painful 1990s crisis. After years of piling on taxes and debt, Sweden nearly went bankrupt in 1992, with interest rates spiking above 500% for a few terrifying days to defend its currency. Instead of doubling down on redistribution, Sweden shifted gears. It cut corporate taxes, deregulated sectors, and embraced entrepreneurs. The result? By the 2000s, Sweden was birthing global brands like Spotify, IKEA, expanded worldwide, and growth surged. The country didn't get rich by squeezing the rich harder. It got rich by letting innovation breathe. Now look at the Netherlands. Long before modern welfare, the Dutch Golden Age in the 1600s made Amsterdam the hub of world trade. Dutch merchants built the VOC, the Dutch East India Company, the world's first publicly traded company, creating wealth through global exchange, not redistribution. That cooperative energy still echoes today. Amsterdam is home to giants like Philips and ING, rooted in open trade and finance. Prosperity wasn't legislated into existence. It was traded, built, and multiplied. Ayau's insight shines here. Value is created when millions of people, workers, entrepreneurs, investors, cooperate voluntarily. Redistribution simply reshuffles the same pie, often shrinking it in the process. Production, however, grows the pie so everyone can get a bigger slice. And here's the twist. If real wealth is born from cooperation, then maybe the real question isn't how to tax billionaires more, but how to unleash more builders, dreamers, and innovators in the first place. So, can inequality ever be solved? Let's face it, people have been chasing this question for centuries. Politicians promise it, economists debate it, and voters demand it. But here's the uncomfortable truth. Inequality doesn't simply vanish because taxes go up. The story is much deeper, and history shows us why. Take Sweden again. In the 1970s and 80s, they taxed everything that moved. Top marginal rates above 80%, sky-high corporate levies, wealth taxes, inheritance taxes. And yet, by the early 90s, their economy was sputtering. The middle class felt squeezed, entrepreneurs fled, and inequality quietly rose. The real breakthrough didn't come from more redistribution. It came when Sweden reformed. The breakthrough came not from more redistribution, but from reforms that encouraged startups and innovation. The Netherlands sits somewhere in between. With progressive income taxes and strong welfare, it still produces billionaires at a record pace. The number of Dutch billionaires doubled since 2008. Why? Because they built businesses that scale globally. Heineken, Philips, ASML. Taxation didn't erase inequality. Innovation widened the gap. This brings us back to Ayau's principle. Inequality shrinks not when you slice the pie differently, but when you grow the pie bigger. Prosperity comes from unleashing human creativity, voluntary exchange, and entrepreneurship. Redistribution can ease pain in the short term, but it can't create the conditions for long-term opportunity. So, can inequality ever be solved? Not in the sense of everyone owning the same, but it can be made less painful and even irrelevant when opportunity expands fast enough that people's lives improve across the board. Think about it. Does it matter if billionaires get richer, if at the same time, education, healthcare, and wages are improving for everyone else? The truth is, taxing the rich doesn't automatically lift the poor, but giving more people the freedom to build, innovate, and cooperate, that's what turns scarcity into prosperity. You've just seen why high taxes don't always close the wealth gap. The real secret to prosperity lies deeper. If you want more hidden stories like this, explore our other videos and join the insiders by subscribing today.